Thanks for tuning into Talking Point. And I'm your host, Niraj Shah. And the case for a chat today. Well, we will ask our guest about whether this persistent trend of DIs investing into the market at all valuations persist. And in fact, the question on valuations as well, that have valuations peaked for the period, or could there be a chance of even further valuation upsides for the Indian markets? And of course, amongst the other things, while everybody's been talking about manufacturing, we try and dwell with our guest today on the consumption side as well and try and understand from him about what are the trends of India's consumption spends and what investing decisions can be made out of that. Our guest today is Ajay Argal. He's Senior Vice President and Portfolio Manager at Franklin Templeton. Ajay, great having you. Thanks for taking the time out. Hope all is well.
Yes, thank you, Niraj. Thanks for having me.
The pleasure is entirely ours. Ajay, one has to admit that the market has kind of stood on the crutch of DI buying for the last innumerable number of months. Now, we've seen indices being buy on dips simply because the flow of money from the retail investor and the domestic investor has been very strong. My question to a portfolio manager like you is that with the valuations the way they are, with global markets doing what they are doing, while you're getting flows, would you be investing that money at the current valuations? Are there enough pockets available, or would you be a bit circumspect and take a bit of a cash call?
Yeah, so as you highlighted, the market valuations are definitely not cheap, but at the same time, there are pockets where it are not too expensive. So if you kind of just segregate even at the market cap level, there is a clear indication that the large caps are kind of reasonably valued. They are not on the expensive side, but whereas if you look at especially the mid caps, then the valuations are definitely on the higher side. So Nifty index, if you look there, I mean, it is trading at around 21 times 1 year forward earnings, which is around 5 or 10 year averages and medians. So it's kind of in a reasonable range. But whereas if you look at the Nifty mid cap index, then it is kind of trading at around 27 times 1 year forward earnings, and which is also kind of a 30-35% premium to the Nifty index. And we have seen in the past that typically those are the limits at which the Nifty, or at which the mid cap index trades. So mid cap on a relative basis to the large caps are on the expensive side. Can they be more expensive? Yes, they can be, like they were in the just immediately after post-COVID, though it was a bit different then because the earnings were much more depressed. So on a normalized earnings, this kind of premium for the mid caps definitely is on the higher side. So that's why we see that the pockets of opportunity which we are getting when we do our bottom-up stock picking, it's much more in the larger caps compared to the mid caps. And just as an aside, even the small caps, they are trading at 10% premium to the Nifty index, which is again close to the peak which they have traded in the past. So coming back to your questions, what do we do in this kind of market? Our objective is always been to get the better stocks within the portfolio, because as portfolio managers, our main job is to invest the money which the investors have given to us in the markets on a fundamental basis. And we generally don't take too large a cash calls, maybe 5, 6, maybe up to 7%, but not beyond that, because we are not kind of the equity funds are not asset allocation funds. They are the funds to get the best stock ideas into the portfolio. So we still see pockets where we think that they can do relatively better. And of course, equity is a long-term investing horizon instrument. So you should not be looking at the immediate short-term, maybe 6 months, 1 year. So definitely over the next 6 months to a year, the investor return expectations should be toned down. But from a longer-term perspectives, all the growth drivers which India have in terms of demographics, in terms of under penetration, in terms of the young population, and the consumption which will keep on increasing as we go forward over the years and decades. Those kind of
Sure.
fundamental long-term growth drivers are there. So it remains a very attractive market, but just a bit of caution from the short term.
Got it. Caution for the short-term opportunities in the large caps, not as much in the mid-cap space. So that is first key takeaway from this conversation thus far. Where is it that you're seeing, Ajay, the best possibility of earnings growth over the course of the next 6 to 12 odd months, based on whatever assessments that you and your team have made about commentary in the first 9 months and quarter three?
Yeah. So we are seeing pockets where the earnings growth is very strong, but you have to balance that with the kind of valuations which are there in those stocks. So obviously, some of the retail stocks, for example, have had very uh, good visibility for the growth, but it's kind of, in our opinion, more than compensated for the valuation. So it's just not the growth which you should look at. You should look at the combination of growth versus valuations, and which is where we try to position ourselves that we generally get into growth at a reasonable price. So from that perspective, we are finding pockets of opportunity when we combine the growth and valuations. We are finding that we are positive on the industrial sector. Though our positivity has kind of reduced because the stocks have done phenomenally well, but purely from the growth visibility perspective, that is the sector where the growth visibility is the highest, because the order books have been strong and the execution by most of the companies in the sector has really picked up. So the top line growth, and then there is the operating leverage, so that improves the margins. So a lot of companies within the sector have good growth visibility, especially over the next 6 to 12 months. And the valuations, though they are on the higher side, they are not terribly expensive. So we are getting pockets of opportunity there. The other sector which has not done so well in the recent past is the banking sector, where the growth visibility is reasonable, though there is a bit of a tone down of expectations in terms of growth as well, because the RBI itself has highlighted that there are certain pockets, especially in personal and unsecured loans, where they want a bit of a lower growth. But even then, the growth possibilities look very sanguine in kind of 12, 13, 14%, that kind of band. And there, the advantage is that the valuations are really reasonable. This is the only sector where the valuations are lower than the last 5 or even 10-year averages. And the margins is kind of normalizing, because we saw very high margins in the last couple of quarters, which was because of the timing mismatch between the asset pricing and the liability pricing. And now that is getting normalized. But in spite of that, we have reasonable growth. Another sector we see good growth opportunities is the real estate. So the real estate, the cycle has really turned, because the affordability has improved substantially, especially over the last 10 years or so, when the real estate prices didn't go anywhere. If you go back 2 years, then 10-year period before that, the real estate prices actually didn't move at all, whereas the salaries kept on going up. So the affordability increased, and therefore there is a pickup in the real estate cycle. The launches, the pre-sales, everything is happening at a very fast pace. So the growth visibility is very strong there as well. And the other sector where we are positive is pharmaceuticals, and there it is actually more stock specific. So there are a few stocks where we see that the growth visibility is very high, and the growth in the domestic market is anyway quite stable, around the 10% band. But certain companies are having specific strategies with respect to the export market. So there is a company who is specializing in the specialist pharma space in the US, another company who is specializing in complex generics, where the competition is much more limited. So there, in those kind of companies, we are seeing growth visibilities with a reasonable valuation. So these are some of the pockets where we see that the growth, especially in the near term, is likely to be very strong.
Okay. Well, we will talk about some of the industrials with Ajay as well, because I remember sometime in December, if I'm not wrong, Ajay and Franklin Templeton were very constructive on power, for example, as a pocket as well. So we'll talk about that too. But just one quick broad macro question, Ajay. Uh, what has made headlines is the fact that FPI ownership in Indian stocks is at maybe decadal lows or thereabouts, and kind of is probably something that is very easy to deduce considering the fact that DIs have been the more active investors as well. Would you brace your portfolio for better valued stocks which may find a fillip as well because of technical reasons of FII inflows coming in at some point of time if the EM inflows return? I'm just trying to understand if there is a tactical play out there in the minds of a large DII investor.
So it is there at the back of the mind, but it's not, I would say, a significant part in the decision making. Because we should be and we are focused on what the growth opportunities are and what the market expectations are as we can infer from the stock prices. So you can work back from the stock prices and try to figure out what is the imputed growth that the market is indicating in a particular stock given the current stock price. So we try to assess that, and then we try to see whether those growth expectations are likely to be met in our opinion or not. And if we see that they are not likely to be met, then obviously we become cautious in those kind of stocks. So on the FIs itself, then there are too many moving parts because it's not only India, it's how the other markets are doing and what other opportunities they get. So it's kind of a call for them on the other opportunities.
Most certainly,
so
Ajay. Sorry, Ajay,
so
but
we
just
don't. So that's the reason we don't focus too much on what their behavior could be.
Agree completely. No, I didn't mean
Yeah.
it that way. All I was saying was that, the common belief is that because FIIs were so overowned in banks, right? And the FI supplies leading to the kind of subdued performance in banks, despite the fact that their quarterly performances haven't been as bad. In some cases, they've been pretty good too, for the larger ones at least. So could that trigger moving, either the selling going away or fresh buying coming in when the buying returns, be a factor that could serve as an add-on to the fundamental performance for banks? Are you invested in banks in a big way?
Yeah, so I mean, we are invested in the banks in a big way, as I highlighted that it is one of our sectors where we think that the growth versus valuation combination is the best. The purely by the very reason that the banking sector, the weightage is the highest in the market in any of the indices you look at, especially the large cap indices or the even the BSE 200, NSE 200, even that kind of diversified indices, or even if you look at NSE 500 for that matter, the weightages are very high. So any investor, when he is selling, then perforce the banking sector will be the sector where the selling will be the maximum. So typically you will find that even in kind of NSE 500, the banking sector weightage is 30%. In a Nifty, it might be a bit more. So if there is any selling, whether it is from foreigners or whether it is from domestic, the large portion will come in the banking sector. So that is something which one has to be cognizant of. But at the same time, it works in reverse as well. When there is buying, then perforce you will have to take exposure to that. I mean, those are as far as the technical things are concerned. So we have all these things in our mind, but as I highlighted, it is not one of the critical decision factors because there are so many moving parts here. And within that, I mean, it's not a homogeneous categories. Even if you look at foreigners, there might be foreigners who have been invested in India for very long and they're sitting a lot of profits, so they might be booking profits, whereas some others might be new and getting in, so they might have a different thought process. And same goes for the DIS and the individual funds which we manage. In certain funds, we might be balancing the sector positions. In certain funds, we might be kind of having a profit booking. So it's so many moving parts there. If you try to figure out from that perspective, it gets very entangled. So we don't usually go there.
We spoke about industrials and consumers as the cases for a chat. Consumption is interesting, Ajay. This whole recent data that has come in wherein the pattern of consumption has changed so dramatically for households at large India-wide. Discretionary spend so much more than basic staples, etc. How are you positioned on the consumption end? Are you at the upper end of the K curve? Are you now betting on staples because they are maybe on a valuation wise as cheap as they have been in the recent past? How is it that you're playing this theme?
Yeah, so generally over the last many months, we have been a bit underweight on the consumption side, and especially the consumer staples. So as you highlighted, there is a dichotomy, and the mass market and the rural side, the consumption is more muted, whereas on the premium side and urban, the consumption is having a better growth. So we still think that going forward, that will be the case, and we continue to remain substantially underweight on consumer staples because we have seen that even now most of the companies are having a lot of difficulty in having volume growth, and especially the companies which cater to the mass market or more towards the rural markets. And but even when they are kind of cutting prices, the volume growth is not kind of improving. So which means that maybe this will continue for maybe some more months. So we are not positive at all on the consumer staples, and this is also need to be dovetailed with the kind of valuations they have been trading at. So in spite of quite a big slowdown in the growth, the valuations have not corrected anything meaningfully. So that kind of makes our underweight position. Whereas if you look at consumer discretionary, we have been positive on the pockets of it. So we had been positive on automobiles, which have already done well. So OEMs as well as certain auto ancillaries. Uh, and then we have some positions in the online food ordering, which is part of the consumer discretionary. So there we see that there is a decent growth both for the market as well as the market share gain from the other players in the food consumption, whether it is from the restaurants or whether it is from some of the other QSRs. So we are having substantial positions in those spaces. So there are pockets in the consumption where we see that the growth is better, and in some cases the company's profitabilities have improved and they've got back on the or rather got on the profitability path. If you look at the online food delivery, which was earlier making a lot of investments and therefore not so profitable. So these are some of the pockets where we see opportunities in the consumption space, but generally mass market we are still kind of cautious.
Okay. The other thing is industrials, and I want to focus maybe not as much on just pure play industrials, but if I can qualify power as a part of that subset. And has that had a phenomenal run, Ajay? Almost all forms of power related businesses, finance, equipment, ancillaries, etc. But that space has some tall ambitions. India has tall ambitions as a country in power. Are you
Yeah.
still constructive here?
Yeah, so we are constructive from the opportunity from the long-term perspective. But as you have highlighted, the stocks have done phenomenally well. So which means that the kind of numbers you are showing, it shows that the expectations is very high in all these stocks. So basically, the market participants are saying that they are very sanguine about the growth opportunities, not even in, I mean, not only in the near term, but maybe even a 3 to 5 year period. They will have the kind of growth which they have not seen in the last 3 to 5 years. Whereas this sector itself, we see that it requires a lot of investments. It requires a lot of execution skills. There are many approvals required, which sometimes take a bit longer than anticipated. Whereas if you look at the stock prices, in our opinion, a lot of them are kind of priced for perfection. So they can still give you returns in line with growth if they are able to execute the opportunity which is there and the expectations which are there on a very clinical basis, basically they execute it perfectly, then they might be able to give you some returns. But whereas we think that that might be a difficult task to achieve. So generally, we have participated in quite a few of them, but over the last few months, we have been trying to book some profits because we think that the markets are really getting very, very optimistic on this side, and one needs to be a cautious, especially considering what they have already returned, and considering that there might be challenges in growth to the extent that the market is expecting. They may not be able to achieve that, and that could lead to some correction in these stocks.
Got it. Ajay, so good talking to you today. Thanks for taking the time out and giving us your sense on a few key points. Much appreciate your time.
Thank you. Thank you, Niraj. Thanks for having me here.
The pleasure was ours. And viewers, thanks for tuning in to this edition of The Talking Point.